Good afternoon, everybody. My name is Ron Friedman, known in the Steam Room as Ronchero. This is another Steam Room video that we're going to do for you guys. And this video is focusing on the iron condor and how and why we use an iron condor. Just a little bit about myself. Been in the Steam Room for quite a long time, 30 plus years of options trading experience, trained by a market maker, as well as tape reading from the man Sanlucci himself. And today I'm going to talk about the iron condor, how it's used, why it's used, and an example of what we've recently used it on. So to kick it off, what is an iron condor? An iron condor is basically two conflicting vertical spreads. So it's a breakdown of a short call, a vertical call, which is bearish, and a put vertical position, which is bullish. This position is sold, or it's AKA a credit, meaning you're going to collect premium on the options. Those of you who like to get a little bit more into the details of the Greeks of specific positions, an iron condor is delta neutral, it is short gamma, it is long theta, and it is short vega. The whole idea of an iron condor is so that we can catch a stock that might be consolidating and trading sideways in price. Why do we want to do that? Well, if we can sell a vertical call and we can sell a vertical put, we can collect premium on both sides as long as the stock stays within a specific range of price. The key to the iron condors is to look for names that you think are trending in a sideways direction that either might have an opportunity to change that direction, either up or down, or if you just like the premium collection strategy and you don't want to mess with a stock that could potentially break higher or lower, but has the ability to just trade sideways. For example, let's take a look at Workday. Workday has a very erratic pattern to it, and you can see by the information that we like to look for on our charts is we like to look for the 50-day moving average, the 20-day moving average, and the 200-day moving average. So represented on Workday, the white line, which is declining, is the 20-day moving average. The 50-day moving average is the blue line. The 200-day moving average is the red line. Are they important to me personally? No, they're not. They're important to the industry, especially the 200-day moving average, whereas we will see institutions like to engage in buying and selling around that price. Their job as institutions and traders and funds is to have an average price on the price of a stock when they acquire it. This moving average, the 200, is an important one to them. So when we see it overhead and curling down, we have an idea that Workday might be pinned in with price. Now on the downside, the only thing that we can look for is to look left on the chart and see if there's memory in this price or structure. So for example, Workday has a range of approximately $200, and we'll just call it $250 on the upside, and on the downside, it has a range of somewhere recently of, we'll call it 215, all the way down to 207. So the job of the trader is to look for and identify either chart patterns that show some type of consolidation, and you have to go into the options chains. Each one of these names is going to have its own options chain, and you need a stock that has weekly options. On Wednesdays, you're going to go in. If you identify something like this, you're going to go in and you're going to look at, okay, can I get away with writing a 250? How much can I collect on that position? Can I get away with writing, let's say, a 215? Or if you're more conservative, can I write a 205 or a 20 or 210? And how much will I collect? How much you can collect and how wide your wings are will determine how much risk there is in the trade and if it is literally worth your time to manage the position. So for example, on a workday, I would have to look at those chains and decide whether it's worth my time. In an opportunity like a Microsoft, because it's a $500 stock, the options are going to be expensive and they're going to come with implied volatility that is typically pumped up. I like to collect a lot of premium, knowing that if I can get it through the weekend, I can typically keep 50% or more of that premium. So if I collect $6 on Monday, I can close the position and keep $3. In a workday, it might not be that high. In a workday, you might only be able to collect, let's say, $1 or $2. But if you can get it to the weekend and you can come in on Monday and close that position and keep $1, that's a 50% gain. And you can just continue to repeat this cycle until or your stock reaches a point to where it's going to make a change in direction. Then you can make the decision whether you want to be aggressive in the position and become a directional trader in that name, or do you want to just shut it down and move along and find the next opportunity? One of the things that I like to do with iron condors is not just use it as a premium collection vehicle. I also like to use it as an offensive weapon. It allows me to be in a trade while a stock is consolidating and figuring out if it wants to make a change in direction. And if it does, all I have to do is alternate one leg of this trade, and then I become a directional trader. So I'm going to give you an example of an iron condor that we traded recently. So if you take a look at Microsoft on Wednesday, this was November 12th, I identified Microsoft being inside of a range. You can see price-wise, you've had a couple of gyrations to the upside. They date back, we had one that dated back to the 31st of July, one that dated back to the 28th of October. Otherwise, in between, price stayed in a relatively stable trading range. It's not perfect. It never is. It never will be. The idea is to eyeball it and see if we've got some opportunity. Well, what was the opportunity? The 50-day moving average being overhead, the 20-day moving average being overhead. And on this day and the day prior, there were a lot of call buyers. Why was that relevant? Why did it catch my attention? Well, because it looked like it could become a directional trade. Microsoft having a habit of reaching technical areas and sometimes not getting through them led me to think, well, if this price does continue to consolidate, I can make money by selling the calls and by selling the puts. So I identified a range and I gave two scenarios. One scenario was if you were an aggressive trader, you have a strike, a 515 strike, which we could have sold, well, which we did sell for about $3.60. And on the downside, we had a put that we sold that was the 490 put, which we sold for about $3. So in these positions, I never take these naked. So in order to make these trades whole, what I had to do was I had to look at 515 and how far was I going to spread that. So that meaning I sold the 515 and I've got to buy something above it, whether it be the 520, the 525, the 530. How wide do I want to be? And that will determine how much of that premium I'm actually going to get to collect and take. So in this scenario, the Microsoft, I was 15 wide on both sides. So I had a 515 by 530. And then on the 490s, I had a 490 by 475. So both of these trades were constructed looking for a break of Microsoft. And my opinion at the time was Microsoft, because of all of the call activity, would break to the high side. That would mean that if I wanted to be directional, I would be forced into buying back the short leg, which is the 515. I would have had to have bought that back to close and immediately bought to open the same line twice the size I had on the short side. So for example, if I had written 10 of the 515s, if I bought the 515s back to close, if I want to be directional and aggressive, I would buy 20 of the 515 calls to open. What that would do is it would leave my vertical spread down here as a directional trade now, meaning I'm going to look to collect that premium and see what I can do about letting that option expire worthless. And if this did move, what would happen is I would look to make money back on that 515, and then I would look to stay in the 430 as an opportunity to continue to catch direction. The conservative side of this trade, which we showed, was you could have also taken a less aggressive stance on the Condor. You could have sold a 530 and bought the 540s. You also, at the same time, could have sold a 480 and bought the 470. Between the two lines, you would have collected about $1.80. The whole idea in these collection strategies is, since we do them on Wednesdays, is to try and hold into the position through the weekend. Since we're long theta, what we'd like to get through the weekend so all of that premium can decay. Once that premium has decayed around 50%, so for example, let's say the 530 and the 480 Condor buyer was, seller was looking to collect about half of that $1.80. They would look for about 50% of that premium to just go ahead and close out and put that money in their pocket. In this scenario, I'm using the Condor aggressively, and I almost always use the Condors in an aggressive way to look for change in direction. My opinion was Microsoft would go higher. The reality was that after we bought this, the next week, when we got to Tuesday, November 18th, Microsoft actually broke down. So instead of staying in the position, I had to buy back the 490s to close them, immediately buying the 490s to open, waiting for Microsoft to make a move, and then taking the 490s off with a profit and hanging on to the 475s, which is what I was also long. And those wound up on Friday, November 25th, those actually wound up paying off. So that was a way for us to get into Microsoft directionally and catch and make a what I would refer to as morphing a trade into a directional position, when originally it started out as a delta neutral position, looking for price to stay inside of a specific range.